Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Investors await the Trump-Zelenskiy talks in Washington for clues on market direction after the U.S.-Russia summit ended without new sanctions or oil trade restrictions. The Ukrainian president facing a tough choice: risk Trump's anger or accept a deal that trades land for a vague security promise, raising fears of future Russian aggression. American Enterprise Institute senior fellow Dalibor Rohac joins us with his view that Trump's current plan may empower Putin while sidelining Ukraine and Europe. Meanwhile, Chinese Foreign Minister Wang Yi is in India today as the two countries get friendlier in the face of Trump's tariff attacks. And thawing ties between the two most populous nations are getting investors excited. TenCap's co-founder Junbei Liu joins us with her insights. Investors looking to Donald Trump's talks with Ukrainian President Volodymyr Zelenskiy and his European allies for direction. This after the U.S.-Russia talks ended without any geopolitical escalation, easing concerns of energy supply disruptions. Zelenskiy is gearing up for another critical face-to-face with President Trump. He's headed to Washington this Monday, flanked by several European leaders, as Trump sets out the terms for a potential peace deal he discussed earlier with Russian leader Vladimir Putin. Trump posting on social media ahead of the meeting that Zelensky can end the war with Russia almost immediately, or he can continue to fight. Sources say while the U.S. is expected to focus on territorial concessions demanded by Russia, Kyiv will seek to pin down possible security guarantees.
It's important that America agrees to work with Europe to provide security guarantees for Ukraine, and we are very thankful to the United States and to the President for such signal.
Since the beginning of Russia's brutal invasion, Europe has been at Ukraine's side, united, and we will support you for as long as it takes, for just and lasting peace. And this peace must be achieved through strength.
Let's get perspective from Dalibor Rohac, senior fellow at the American Enterprise Institute. Dalibor, good to have you with us. We heard from Trump. He says Zelensky can end the war almost immediately. You get a sense that, according to him, the onus is on Zelensky to accept the terms laid out by Putin.
But it really is an extraordinary development, because for weeks and weeks we've been hearing about how President Trump was running out of patience with the Russians. On August 1st, he called the Russian strikes against Ukrainian cities despicable. He talked about a 15-day ultimatum to Russia, then about an 8-day ultimatum to Russia. And going into the Alaska summit, he said that unless he could secure an immediate ceasefire, there would be severe consequences for Russia. Yet, Vladimir Putin offered nothing in terms of concessions, nothing in terms of constructive proposals to end the war. He just regurgitated his maximalist demands, and yet now the US president seems to be under his spell, putting the onus on Ukraine and the Europeans, as you put it, and that really puts Ukraine and Europe into a hard spot, thinking that perhaps the United States is no longer the guarantor of European security, no longer a trustworthy partner, but an emerging ally of the Russian war effort.
So not a great starting point for Zelensky when it comes to this Monday meeting. Doesn't matter whether or not he has the European leaders on his side. How much room to maneuver, to actually negotiate terms?
I mean, the real question for President Zelensky and for the European leaders is whether the U.S. approach is really set in stone, whether this is the course that the U.S. administration is going to be following, or whether there is any room for changing hearts and minds, because it is very easy to demonstrate that making concessions to Putin, trying to appease Putin, trying to push Ukraine into an unfavorable deal that only enables Putin to rearm and restart the war a few years down the line is not in the US interest, even not in the personal interest of Donald Trump, who a few months ago negotiated this minerals deal with Ukraine and basically giving away Ukraine's land to Russia jeopardizes that very deal.
So in the end, will it be about security guarantees? I mean, when you take a look at the battlefield, it is not working in Ukraine's favor. Russia is making inroads, albeit slowly, but Ukraine is not winning in any way.
Well, I would challenge that premise, to be honest. I mean, Russia went into this full-scale invasion in 2022 with the ambition of taking over Ukraine, and that has really gone terribly wrong for Russia. The front lines have been stable. Obviously, there is a lot of bloodshed. There is the constant pounding of Ukrainian cities, but the sort of small breakthroughs that happen along the front line in Donetsk are far from being kind of operationally or strategically important for Russia. So the idea that Ukraine is somehow losing the war, whereas it is Russia that started this conflict with really maximalist expectations, maximalist objectives, and has failed to achieve those objectives and has suffered a terrible human toll. I don't think that's quite the right framing. And in the end, it will be Ukraine itself that will be its own best security guarantee going forward, I suspect.
Are the security guarantees enough? We heard from Steve Witkoff saying that Russia has agreed to such terms, but is that enough for Zelensky?
Look, if you look at it from the European perspective, right now there is a debate taking place about whether Article 5 guarantees and whether NATO itself provides for sufficient security guarantees to countries on NATO's eastern flank. So the idea that a piece of paper that would be signed by President Trump and maybe other Western leaders would provide sufficient guarantees for the Ukrainians, I think is fanciful. I mean, Ukraine already has security guarantees from 1994 from the Budapest Memorandum, and obviously paperwork and signed documents do not provide deterrent force in their own right. And right now, again, the strongest security guarantee that Ukraine has is the determination of the Ukrainian nation and the skills of the Ukrainian defense forces and the successes that they have shown on the battlefield defending their country against the Russian invaders.
So what now then, Dalibor? If security guarantees are not good enough for Zelensky and Putin isn't likely to give in any more than what he's laid out to Trump, where do we go from here? What next? What happens?
I mean, the US administration has ample space to put pressure on Russia, to put really debilitating sanctions on the Russian economy. There is the Graham-Blumenthal bill awaiting passage in the Senate that would sanction the purchasers of Russian oil and gas worldwide. There are other tools in the hands of the administration, including enforcement of existing sanctions, including lethal aid to Ukraine. There is no reason why Russia, an economy of the size of Italy's, should be holding the whole world hostage. But if that's not the path taken by the administration and by President Trump, I think the ball will be in the court of the Ukrainians and of Europeans. And I very much hope, for the sake of the Western alliance and for the sake of democracy in Ukraine and in Europe, that Europeans and Ukrainians will be able to sustain this defense effort and will not yield to the pressure and to the bullying that is now coming both from Moscow and apparently from Washington.
The thing is, Dalibor, there is no reason to think that Russia, or rather the US, will impose new sanctions when the old sanctions, the original sanctions, have not been implemented well. And we saw at that meeting in Alaska how President Trump actually laid the red carpet, allowed Putin to ride in the beast. So there's really no sense that the US is willing to take the hard stance.
And again, that's something that makes the whole situation extraordinary. Donald Trump said that he would know within 2 minutes of meeting Vladimir Putin whether Putin was serious about trying to achieve peace. He promised that he would push Russia to agree to a ceasefire in that meeting. Otherwise, there would be severe consequences. And yet, Russia agreed to none of that. And there is no pressure coming out of Washington. And I'm afraid to say that this really makes President Trump look weak in the eyes of the world, looks him as somebody who is not credible on the world stage, who, much like Republicans were complaining about President Obama's unenforced red lines in Syria. I mean, this is 100 times worse because the geopolitical stakes are just so much higher.
At the crux of it are land swaps. What do you see happening here? Do you see Russia getting what it wants, getting Ukraine to withdraw from the Donetsk region?
It's an interesting word you used, land swaps, because I've yet to hear about the lands that Russia is offering to Ukraine in exchange for the territory it is asking Ukraine to cede to Russia. Obviously, this whole pressure on Ukraine to cede territory basically involves rewarding Putin for his aggression against Ukraine by giving him lands he has not been able to take over militarily, and trying to award him these lands at the negotiating table, essentially in exchange for nothing. And so I don't think that's a viable proposition for any Ukrainian politician, and I don't think it should be a viable proposition for anybody who cares about peace and security in Europe. It's been the case since 1945 that borders in Europe have not been revised, changed by force. And it's been the United States, in part, that's been a guarantor of this order, of this basic rule of conduct. And if tomorrow brings an abrupt end to that system, I think it will be really bad news for everybody in Europe and beyond, including in countries of Asia.
So, Dalibor, after a 10-minute conversation, I get that we're not seeing land swaps, we're not seeing security guarantees, so we won't be seeing that meeting between Trump, Putin, and Zelensky.
Well, one thing we will be seeing, I think, is Ukraine an agency. Ukraine has demonstrated that it is a viable country that cares about its own self-determination, that is willing to fight for its future and for its freedom. And I don't think great powers carving land in sort of 19th century colonial manner are going to change that. And that is something that gives me hope, not just for Ukraine, but also for Europe and for the future of the rules-based international order, if you will.
What do you make of the pursuit of an agreement without first getting a ceasefire? That seems to be what Trump is pushing for.
Well, Donald Trump originally pushed for a ceasefire. Then he saw President Putin for 2 hours and basically endorsed the Russian rhetoric about seeking the end to the war through a peace agreement, which would supposedly address what the Russians call the root causes of this war. But the root cause of this war is not that Russia would not have enough land and would need land in the Donetsk and Luhansk regions of Ukraine. The root cause of this war is this idea that Putin has in his head that he has the same place in Russian history as Peter the Great and Stalin, that he is to recreate the Russian Empire by conquering Ukraine. And unless he is disabused of that notion, I don't think we are able to arrive at a definitive resolution of this conflict.
Is there any role NATO can play, a productive role that NATO can play at this stage?
Well, NATO has been vitally important in coordinating the effort to help Ukraine militarily. The Ramstein meetings involved NATO allies in various formats. Eventually, should this war come to an end with Ukraine still intact, I think NATO would provide the obvious security framework for Ukraine to be protected against future Russian aggression. NATO's deterrence works on the eastern flank, much as it's being questioned now, or rather, U.S. commitment to the alliance is being questioned. But as of now, nobody is talking about bringing NATO into the conflict in an open and direct way. Nobody's calling for U.S. or Western European boots on the ground in Ukraine. I mean, it is Ukrainians who are doing the fighting. All they are asking the West to do is to support them in their effort through military assistance and through effective sanctions. And right now, I'm afraid to say that the U.S. administration is failing them on both counts.
Dalibor, you gotta wonder how China's looking at it, how North Korea may be looking at it, and what some of the messaging they may be getting from what's happening in Ukraine right now.
Well, I think the Chinese are certainly looking at how serious and determined the United States is to stand by its prior commitments, and that has relevance, obviously, in Taiwan, in the Philippines, for other Indo-Pacific allies. And I think it's also many other countries that would have quasi-imperial ambitions or would harbor grievances about unfair borders around the world that might be looking at this situation. And they might be wondering whether they might not be able to get away with more than what they have thought thus far. And I think in a world in which Russia is able to grab a piece of Ukraine and then have it ratified by the world's leading power, is a world that will be fundamentally more unstable and dangerous and conflict-ridden than the one that I grew up with and that I took for granted until recently.
Dalibor, thank you so much for your perspective today. Dalibor Rohac, Senior Fellow at American Enterprise Institute. Now, President Trump says he's holding off on raising tariffs on Chinese goods over the country's purchases of Russian oil. That's after citing progress made with Vladimir Putin during their summit in Alaska. Trump earlier this month had threatened buyers of Russian energy with additional tariffs as a means of pressurizing Putin into peace talks with Ukraine. China and India are by far the two biggest buyers of Russian crude. Trump has already announced he's doubling duties on Indian products to 50%. But raising tariffs on China would risk breaking a trade truce that he's agreed to extend for another 90 days. However, Trump's tariff pressure on China and India are helping forge stronger ties between the world's two most populous countries. Chinese Foreign Minister Wang Yi is visiting New Delhi today, making his first trip to the country in over 3 years. For more on this, our government reporter Sudhir Ranjan Sen joins us live from New Delhi. Sudhir, it does look like Trump is forcing this thaw in bilateral ties.
Well, I mean, yes and no at the same point of time. The fact that U.S. has become, or U.S. policy is becoming very erratic is something that is playing on the minds of Indian policymakers and is largely or partly responsible for the thaw that we are seeing. And having said that, this thaw, however, is, started before Trump came into office. For the second time in January this year, the India and China, started to look at normalizing relations from last year, and the big breakthrough that we saw was both sides pulling back troops from the disputed parts of the border, and then Prime Minister Narendra Modi and President Xi Jinping meeting in Kazan last year, setting the ball rolling. But definitely, yes. The tariffs, the threat of penalties for buying Russian energy has added a lot of more urgency to normalize the relationship, to get the relationship back to a working order where both sides, if not pre-2020 when the border skirmish happened, to levels of that, but to some level of normalcy where trade, people-to-people connect can start once again.
What are the priorities of this meeting?
Well, to begin with, this is going to be a very important meeting. And the reason why we think it is going to be very important is this is the meeting that is basically setting the tone for Prime Minister Modi to meet his counterpart, President Xi, later in the month. And much of what is going to, be discussed and therefore agreed upon is going to be, discussed here, both at the level of the National Security Advisor and with the Foreign Minister. For Chinese Foreign Minister Wang Yi is both meeting Ajit Doval and Jaishankar. So much of the policies or much of the discussion, the announcements, how far both sides will go, how far both sides will normalize and get back a working relationship is going to be decided in these meetings.
Sudi, talk to us about the paradox of China-India relations. I mean, as you mentioned, there are lots of areas that both sides can work and cooperate on, but they are constrained by unresolved tensions between the two sides as well.
Well, it's definitely yes, because there is a sense of a trust deficit that was there, and that has been deepened because of the border skirmish. And this is the border skirmish, which was the worst that we have seen in the last 4 decades. Soldiers died, which never had happened earlier, except for the 1962 India-China war. So a lot of trust needs to be built. On top of that, there have been instances where India has complained about Chinese predatory, commercial, methods and tactics. Those had come at a level after once, the two countries have kind of settled or feel comfortable again at the borders. So, it's a long way to walk, but the beginning of that has already started.
But to be sure, India needs China in a huge way. As Modi aims to be a manufacturing hub for the world, it does need all the raw materials from China.
It does. And despite the fact that, India has been discouraging Chinese investments since the border skirmish, India pegging the entire relationship to peace on the borders. We have heard Foreign Minister Jaishankar repeatedly say that the relationship was not normal. Of course, this was prior to the entire meeting between the two leaders. We have seen him repeatedly saying the relationship is not normal, and what happens at the border affects the overall relationship. But having said that, we have seen senior members of the government go out and bat openly for Chinese investments into India, indicating that there is a very strong, section in the government, or there is a large section in the government, which thinks that Chinese investments is necessary and India should go for it.
Sudi, thank you for that. Bloomberg government reporter Sudi Rajan Sen in New Delhi. Still ahead this hour, we'll talk global market risks, from the Ukraine peace talks to President Trump's tariff deals, with 10Cap co-founder Junbei Liu. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here are some of the top global stories we're tracking. Hundreds of thousands of Israelis have rallied amid a nationwide strike demanding an end to the war in Gaza and a deal with Hamas to release the remaining hostages. Organizers of the biggest protest in Tel Aviv say 500,000 people gathered in what's now known as Hostage Square. Netanyahu's government this month gave the army the green light to take control of the de facto capital, Gaza City, and crush Hamas holdouts. China is escalating its trade fight with Canada, filing a WTO complaint over Ottawa's steel tariffs and quotas. Beijing calls the measures typical trade protectionism after also slapping duties on Canadian canola. Tensions have grown since Canada moved against Chinese steel, aluminum and electric vehicles. Ottawa says it's protecting domestic producers hurt by U.S. tariffs. The UK, Japan, South Korea and the EU are among U.S. trading partners waiting for Washington to deliver on promised tariff concessions. UK steel lobbyists worry the commodity has slipped in priority for President Trump and Prime Minister Keir Starmer. Meanwhile, Japan's top negotiator says the bleeding hasn't stopped for its auto sector, urging the White House to implement their deal. South Korean carmakers are facing similar strain as they wait for the trade deal announced on July 31st to become a reality. And EU chief Ursula von der Leyen is also awaiting the enforcement of an all-inclusive 15% tariff on European goods 3 weeks after it was announced. Let's bring in Junbei Liu, co-founder and lead portfolio manager at TenCap. Junbei, you got to imagine that traders have already looked past tariffs and perhaps even the situation in Ukraine. Now the attention shifts to Jackson Hole.
Yeah, absolutely. Look, hi, thank you for having me. Look, equity market has been really resilient, and then the investors are being very, very pragmatic. And now there seems that we are now, gradually getting different trade deals. And with China, there's truce, and then there's extension. Seems to be making the right step, and that's good enough for the investors. And then Jackson Hole, of course, it seems to be now what everyone's talking about. What does that mean for for the path and the tone, whether it's dovish, whether it's hawkish. I think, taking a step back, I don't think that's an event that you get a lot of information. All we know is that, inflation is on the way down, and there will be rate cuts. And increasingly, there's more expectation for, the almost 90% probability of a cut in September. We think there's a few more to come later this year. So look, all that together is bode pretty well for the equity market and for investor confidence.
So the S&P can grind higher, can test new highs from here?
Look, we do think so, but that's not to say that we won't have any volatilities. In general, if you look at the equity market seasonality, is that August normally is a softer month, and then heading into September it's a bit softer, and then we rally into the year end. But this year, of course, August has actually been pretty good. It's partly because the economic reality, as we said, is actually not as bad as we expect, and the inflation is not as bad. The pickup in inflation as a result of trade hasn't been as bad, and so we've seen the market is being supported. And at the same time, we also have this rate cut to underpin the valuation, to underpin the investor confidence and financial liquidity. So so sort of we're seeing the bit of positivity and grinding higher. But look, if there's any time that we do have equity market volatility or sell-off, it's absolutely a buying opportunity. Investors should be buying on the dip. If it should that happen.
The thing is, we're all waiting for the tariffs to bite. And if you take a 12-month period, would you agree that U.S. stocks will get hit more than the others because of the pain the U.S. economy is likely to feel versus the international economy?
Look, to be honest, we were thinking that. Look, many investors thought that, 4 months ago, when first the trade discussions started taking place, hence why the sell-off across the U.S. stocks and tech. But since then, we've sort of seen this remarkable pickup and also incredible resilience in the U.S. economy. And we've yet to see, the really significant inflation pickup there in the U.S. So look, I'll be holding back. But, technically, you should see improvement in other markets or the outperformance of other markets relative to the U.S. And we do think for the next 12 months, however, you will see this rotation from, a lot of, yesterday's winner will be moving, will probably become the funder. So U.S. equities potentially could become the funder for every other economy. We have so far seen a lot of outperformance out of emerging economies and China and others, despite all that trade uncertainty. So, we do think that there's a level of rotation to come through, but we still think the U.S. market probably will grind higher too, given how resilient it's been.
The thing is, sentiment will be driven by what comes out of Jackson Hole. What kind of messaging are you expecting from Jerome Powell?
Look, I think he will continue the current trajectory of what what he has been saying, that essentially it will be data-driven. They will wait and see. But however, the data has come through a little worse than expected. So we do think the rate cut is on the cards. But I don't think he will change the trajectory. I don't think he will in a rush to become very dovish, because they want to see, what the trade deal finally look like and what its impact being. I don't think they want to be preempting some of those weaknesses too soon.
So how are you positioned for what's to come? Which assets are you attracted to right now?
Look, I think, for me, equity market is the best place to make great returns. And as a long-short manager, this is, you can control your risk, and this is a fantastic environment for us. So we do think, though, as I mentioned before, next 12 months, you need to look for sectors that will benefit from a cyclical upswing because we got the rate cut around the world taking place, and the U.S. and then the emerging economy, and that kind of support will support the valuation and the cyclical upswing. We are seeing, early stage of that rotation taking place in the last few months, particularly this reporting season in the U.S. You've seen some of the more expensive sort of or more defensive, parts of the market being sold off, and see investors taking profit and putting into more cyclical parts and smaller companies as well, simply because next 12 months their earnings will do better as interest rate cut take place. We've seen in the U.S. the home builders having a massive rally, even though underlying fundamentals still pretty poor. So look, I do think that this is where you go into smaller, go into more cyclical. Your growth leader is still great. AI spending is still there, but I just think that some of them have done really well. It's time to move into some of the other space that you can make lots of money.
And how are you thinking about Chinese stocks? Because they've been pretty lackluster, even though they haven't been touched by sanctions much. If you take a look at how the stocks have been doing, only about 9% of the stocks have actually tested new highs.
That's right. I think Chinese stocks still look pretty reasonable value when you compare to some of their global or Western peers. So, it's partly because, as you mentioned, the economy is still coming out of it. And even despite all the continuous stimulus, the consumer is, only gradually coming out of, what was a very patchy, very, very tough few years. So, however, we do think that with the government ready to pull the trigger on the stimulus, once the outcome of the trade negotiation is decided, we do think it will be those sectors, particularly consumer sectors, will be very, very interesting, and I think they will continue to recover. These sectors we've seen around the world coming out of COVID and others all had a huge rally, whereas Chinese sector they never did because the Chinese consumer has been doing it pretty tough. So next couple of years could be a huge tailwind for them to do significantly better than others.
Do you see mega caps like Xiaomi continue to grind higher? How much more upside might they see?
Look, I think China equities at this stage looks pretty supported, simply because that one is valuation and two is the cyclical upswing that we were talking to. Of course, what will happen with the final trade deal is going to determine their final performance. But taking a step back, these sectors, these companies, Xiaomi has been underperforming for years relative to what's been traded with the Nasdaq. So, so we do think there's a lot of opportunity. I'd be staying with it, and I do think that they are grinding higher.
And Junbei, even as you stay optimistic when it comes to Chinese stocks, what do you deem as the biggest risk for them?
Oh, look, the biggest risk, look, at this stage, it's very clear. It is the trade. The trade, if there isn't a trade deal, if there's more escalation of trade, trade tariff and conflict, that's clearly going to put a huge dent on what is going to come. Market is taking the view at this point is that both countries will be pragmatic as some sort of deal will come through, and that it will be more reasonable than expected. So, that will be the biggest risk faced by the Chinese market at this stage. Now, going forward, though, the China does have quite a few sectors that's structurally challenged, and then with the housing sector and the like, it still seems to be struggling to really find its footing. So, with the stimulus that's to come, that's been rumored again targeting a more consumer and smaller businesses, but that is just not enough. We're still waiting to see what's going to really arrest and reform that whole housing market. Maybe enough consumer confidence is enough, but it just seems like that's a much bigger medium-term problem.
Junbei, hang tight. 10Cap co-founder and lead portfolio manager Junbei Liu is sticking around. India starts trading in about 4 minutes from here. Let's take a look at what the opportunities are looking like for the Indian markets amid warming ties with China India now just minutes away from that open. The Sensex pointing to higher open, up 9/10 to 1%. Remember that promise Narendra Modi is planning to cut tariffs on everyday goods, which could help soften the blow of potential U.S. tariffs. It is pointing to a positive open. Keep it here with us. This is Bloomberg. Welcome back. One consequence of India's growing diplomatic rift with the U.S. is a move closer to long-standing rival China. And in today's Taking Stock shows some Indian firms with links to China might see a resurgence thanks to those thawing relations. For more, let's bring in senior Asia equities reporter Abhishek Vishnoi, so you know where to look.
Absolutely. And, this is a set of companies which is possibly going to outperform a bit. It has started outperformance this week. It's not a new theme. This was a theme, before tariffs war started. I mean, there were a lot of China-linked companies consuming inputs, partnerships, technology coming out of China and India. There were also companies backed by Chinese money. But, at the bottom of it was this issue whether government is going to be friendlier towards such companies or otherwise friendlier towards Chinese goods and Chinese money. But now that it's in open, it looks like, government has no qualms about, receiving Chinese money. Government is okay as far as Chinese inputs are concerned. So all these sectors like pharmaceuticals, electronics, which have gained immensely, from made in China, are going to benefit now from a lower input cost. And there is an increasing comfort around companies which are partnering Chinese companies or receiving money or investments from them. Now, this is definitely a tailwind for this set of companies, but it does not solve India's problem. It's not a tailwind for the India market per se, which has been underperforming, which has its own set of issues.
So is it broad-based when you talk about pharmaceutical companies that might benefit, manufacturing companies, even, tourism-related companies? Are there specific companies which will likely benefit more than the others?
Absolutely. And, the sector that you mentioned first, pharmaceuticals, probably going to benefit most. It's a well-known fact that, after U.S., the highest number of US FDA-approved plants are in China and India. So, these two countries benefit a lot. We've seen a resurgence of, innovation in China, right? And something similar happened in India. But now, given the gates have been opened, for Chinese and Indians to get closer further in terms of investments and other things, there are a lot of inputs which are essentially, very cheaply available in China. So Indian companies would save on capex. Indian companies would save on their operational costs because they'll be importing those APIs or building blocks as pharmaceuticals to India, and then they'll be making those finished dosage formulations, drugs. So pharmaceuticals would gain. Electronics would gain the same way. I mean, Voltas used to get a lot of its parts made in China, then assemble a little bit in India, and then it was a made in India product. But now a lot of those companies would be very confident in importing those products. So these two sectors would definitely gain the most. But there are very big other sectors like industrials or banks and so much more in India. So it won't become a big tailwind for India. Probably the bigger tailwind for India would now be the tax reforms that government is pursuing.
Right. We'll leave it there for the moment. Abhishek, senior Asia equities reporter, Abhishek Vishnoi there. Let's do a check on Indian markets right now. It's just kicked off its trading day. It is in the positive, the Sensex, along with the other benchmarks. But bear in mind that it is from a lower base. The Sensex currently up by more than 1%. India doing much better than the rest of the Asian region at this point in time. Year to date, though, the Nifty is only up by 4%. The world index higher by 13% with it the same time frame. Let's get perspective. Junbei Liu from 10Cap is still with us. Junbei, your thoughts on India? Are you still liking or, just trepidation perhaps in view of the tariffs that we're seeing?
Look, I actually think the Indian market looks very interesting now. If you remember, 12 months ago, or 12 months ago, people couldn't get enough of Indian markets, and they were trading on very hefty multiples. Just because the way it's somewhat separate from Chinese economy, and then it's got its own really strong growth drivers and very tech bent and the like. And now, because of tariff, it's clearly now that we're seeing the market sort of struggle somewhat and lagged behind. It does see, create quite an interesting opportunity. You talked earlier about some of the sectors facing the closer link with China and the like. But I do think net overall market is looking very interesting relative to others. We have seen this from other markets when we talk about whenever there's a tariff news headline come through and the market gets sold off, and then subsequently when we have better deals or when we actually have certainty with the deal, we then see the market rally away from there, and it's every time it's proven to be good buying opportunity. So I do think that India, just from a top down, actually looks very interesting now.
The thing is, the AI theme is a strong theme throughout the world, but when it comes to India, you can't really play the AI theme in India, and some perhaps say that that is detrimental to the outlook for the market.
Yeah, that's true. But they do have growing other sectors as well. And remember, Indian economy is a somewhat very, very, very self-sufficient. And then it's very, very diverse. It creates that diversification for the global investor portfolio. If you look across the Asian portfolio, most of the economy is somewhat linked to what China is doing. Of course, you've got Japan, and then you've got India on the side. It is running a very different race now. With the AI seems to be decoupling, really driven into China, and then the more the Nasdaq, the Western pack. But I do think, given the valuation, it does have its own, the strength underneath.
India versus China, which is more attractive, Junbei? That's the perennial debate.
You know me. Look, absolutely. You know me. Look, I think China represents incredible amount of opportunity. It's some sector may look a little bit more expensive, but if you compare to what's happening globally, they look very, very attractive. China, though, the main, the main risk, the challenge is that their tail risk every now and then becomes real. So, with China, you need to be pragmatic. Once you made your return, you do have to rotate into other sectors. And also China, you've got to invest with the government, not against it. So there's a lot of things into invest in China, but I guess it's similar to India. But just from this perspective, tactically at this point, actually India looks quite attractive at the moment.
How are you looking at the government's efforts to revive household confidence? It's been very challenging for the government, and we know that Chinese consumers prefer to save than to spend, and that has been the problem for Xi Jinping.
Look, I tell you, exactly. And I do think, though, being the Chinese myself, that, Chinese people love to take on risks. When they feel comfortable, they will take on risks. So look, the consumer participation or, the retail participation of the share market, it's been actually quite incredible in recent months. There's been a lot of retail investors or individual mom and dads now already coming back into the market in a big way. And this is in China. And then it is the institutional investor actually are selling the market, taking profit. So, that is usually a sign that consumers feeling a bit more confident, a little bit better. This also coincides with, improving confidence. You've seen some of the consumer, sectors doing a little bit better, people spending on experiences and, their toys and the like. So, so all that together, it does show Chinese consumer incredibly resilient. And then the good sign is that they are finally coming around the corner, doing a little bit better. Still underwater, but doing a little bit better. And then with government continuously giving them, more and more support to help them through, I do think that they will increase their spend.
Talking about support, how much support do you think emerging markets can get in the coming quarters, given the optimism around China as well as India?
Yeah, look, I think it really depends a little bit on what's going to be the narrative for the trade now, because the market, we had a big, actually, market has performed pretty well, both emerging economies and even across the developed economy as well. So we kind of need a bit more news flow, just in terms of more solid, story about more deal to be signed and what is the final detail. So for it to come through to really have the next leg up, I do think the market probably will be somewhat in a holding pattern and waiting for more news flow to come through. And once that we have more certainty, particularly, of course, the most important will be China and the US. And once we have more certainty, then the Chinese government have every likelihood will start pulling a trigger on the stimulus package that is, the right size for the deal.
And for most EMs in Asia, a weaker dollar and cheaper oil would benefit them for the most part.
Absolutely. It's all looking good.
It is looking good indeed. Junbei, thank you. Junbei Liu, co-founder and lead portfolio manager at 10Cap. Speaking of oil, let's take a look at how oil is trading at this point in time. Traders looking ahead to that Trump-Zelenskiy meeting in Washington on Monday. Brent crude currently flat at 65.83. New York crude higher by about 0.1%. Keep a close eye on that meeting in Washington between Zelenskiy, Putin, along with those European leaders. U.S. futures are looking like this as traders look ahead to the week, to Jackson Hole, the messaging that they might get from Powell at this point in time. S&P futures currently up by about 0.1%. And before we go, here's a look at tomorrow's show. BHP CEO Mike Henry will be joining us live to discuss full-year results for the world's biggest miner, plus market analysis with Rockefeller International Chairman Ruchesh Sharma. Hear why he thinks President Trump's tariffs have been far less disruptive than expected. That is it from Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.